8 months of buying. Then this, China's gold ETFs, finally reverse. For 8 months straight, something never stopped. Money kept pouring in, every single month, without a break. Then, in one quiet month, it stopped. And what happened next? Nobody expected. Because while everyday investors were pulling their money out, someone else was doing the exact opposite, buying more gold than they had in months. Two forces moving in completely different directions at the very same time. And by the end of this video, you will understand exactly what that means for your money, for gold, and for what comes next. Welcome back, my friend, to John AG. If you are new here, take a seat, get comfortable, maybe pour yourself a cup of tea or coffee, because what we are about to explore today deserves your full attention. And before we begin, if you find value in what this channel shares, please do an old man a small favor. Press that subscribe button. It costs you nothing, but it means everything to a channel like this one, run with care, built on real research, not noise. Consider it a small handshake between us, a way of saying, yes, I want to keep learning from you. Now tell me, where are you watching this from today? Drop your city, your country, down in the comments below. This old storyteller loves knowing who is sitting on the other side of the screen. Now, let us begin. For 8 consecutive months, something unusual had been happening quietly in China. Investors kept putting their money into gold. Month after month, without interruption, funds flowed into gold ETFs, a type of investment that lets ordinary people buy gold without holding physical bars or coins. It was a steady, disciplined pattern. No breaks, no pauses, just consistent buying, month after month, for 8 months in a row. Then, in May, that pattern broke. For the first time since August of the previous year, money did not flow into these gold funds. It flowed out. Investors who had been buying gold for 8 straight months suddenly changed their behavior. They began selling instead. The amount was significant. In just 1 month, over $1 billion left Chinese gold ETFs. The total value held in these funds dropped by 5%. The actual gold being held by these funds also declined, falling by more than 8 tons in a single month. To understand why this matters, one must first understand what this pattern represented. For 8 months, Chinese investors treated gold as a safe place to put their money. Gold has always carried a reputation as protection during uncertain times, a place where wealth holds its value when other assets become shaky. When people keep buying something for 8 months straight, it usually reflects trust. It reflects a belief that this asset will protect their money. So when that trust broke, even for 1 month, it was worth asking why. Analysts who studied the data found 2 clear reasons. First, China's stock market performed well during that month. When stocks are rising and generating strong returns, investors often move their money away from safer assets like gold and into stocks, chasing higher, faster profits. This is common. When one investment option looks more exciting and one looks flat, money tends to follow the exciting. Second, the price of gold itself was not moving in any clear direction during that month. It was neither rising sharply nor falling sharply. It was simply sitting still, uncertain. Investors who prefer clear trends, who like to see an asset clearly climbing or clearly falling, often step back and wait when a market shows this kind of hesitation. No clear signal often makes short-term investors nervous, and nervous investors tend to sell and wait. Both of these reasons made sense on the surface. They did not suggest people had lost faith in gold entirely. They suggested people were simply chasing better opportunities elsewhere for a moment, while gold consolidated and paused. But here is where the story becomes far more interesting. While these everyday investors were quietly stepping back from gold ETFs, choosing stocks over safety, someone else in the same country was doing something completely different. Someone was buying more gold that month than they had bought in nearly half a year. Someone with far deeper knowledge of long-term risk, far more resources, and far less concern about 1 month's stock market performance. 2 groups, same country, same month, same asset. One group was walking away from gold, the other was buying it aggressively. This divergence is not something that happens by accident. When retail investors and major institutions move in opposite directions on the very same asset in the very same month, it tells a story that deserves careful attention. It raises a question every serious observer of markets should be asking right now. If gold is losing appeal to everyday investors chasing quick stock market gains, then why would anyone with real resources, real patience, and a much longer view of the future be buying more of it than they had in months? That question is where this story truly begins. The story did not end with ETFs. In fact, the ETF outflow was only the surface of something much bigger happening underneath. When researchers looked deeper into China's gold market that same month, they found a pattern that was even more alarming. Physical gold, real bars and coins moving through the country's largest gold exchange, showed a sharp decline. Withdrawals from this exchange dropped by nearly 40% compared to the month before. That is not a small dip. That is a dramatic collapse in just 30 days. And when compared to the same month 1 year earlier, the number was down by more than a third. But here's the twist that made analysts sit up and take notice. This was not just a weak month. This was the weakest reading for this particular month in 16 years. 16 years. To find a time when Chinese buyers withdrew this little gold from the exchange during this specific month, one would have to travel all the way back to 2010, a completely different economic era, before smartphones dominated daily life, before China became the economic powerhouse it is today. This was not a minor fluctuation. This was history repeating a warning signal not seen in over a decade and a half. So what was pulling everyday demand down so sharply? Three forces were quietly working together. First, the uncertain price of gold discouraged buyers. When gold's price is not clearly rising, people who buy gold as protection against uncertainty hesitate. They wait. They watch. Nobody wants to buy something today if it might be cheaper tomorrow. Second, just like with the ETF story, the strong stock market pulled attention and money away from gold. Investors were distracted by faster, flashier gains elsewhere. But it was the third reason that revealed something deeper about ordinary people's daily lives. Gold jewelry demand was struggling. Badly. Jewelers across the country were hesitant to restock their shelves. Why? Because gold, even after falling from its highest price ever recorded earlier in the year, was still remarkably expensive by any normal historical standard. A person who once bought a gold necklace at a certain price years ago was now looking at a completely different, much higher price tag for that same item today. Even though gold had cooled down somewhat, it had not cooled down enough to feel affordable again to everyday families. Add to this new tax pressures placed on certain gold transactions inside China, and jewelers found themselves in a difficult position. Buying more inventory felt risky when customers were already struggling to justify the cost of a simple gold ring or bracelet. This is the part of the story that rarely gets discussed in typical market commentary, but it matters enormously. Jewelry demand is not driven by traders sitting behind screens making calculated bets. It is driven by real families, real weddings, real gifts, real everyday people deciding whether they can afford to buy gold for their daughter's wedding or their mother's birthday. When that demand dries up, it is not a technical signal. It is a human one. It tells a story about affordability, about squeezed household budgets, about ordinary people quietly stepping back from an asset that has simply grown too expensive for daily life. So now the picture becomes clearer and more troubling. Investors selling ETFs, jewelers refusing to restock shelves, physical gold withdrawals falling to levels not seen in 16 years. Every single indicator pointing toward hesitation, caution, and retreat. If someone only looked at this part of the story, the conclusion would seem obvious. Confidence in gold, among everyday Chinese consumers and investors, was clearly weakening. But then comes the twist that changes everything. Because while retail buyers were stepping back, while jewelers were sitting on their hands, while wholesale demand was collapsing to a 16-year low, someone else was doing the complete opposite. And this time, the numbers behind that opposite move were even larger than anyone expected. While ordinary investors were quietly walking away from gold, one buyer in China was doing something remarkable. This buyer was not a nervous retail trader watching stock prices climb. This buyer was not a jeweler worried about empty shelves. This buyer was the country's central bank. And what the central bank did that month defied everything happening around it. The central bank added 10 tons of gold to its official reserves in a single month. That may sound like a simple number, but consider what it actually means. This was the largest monthly gold purchase this institution had made in nearly half a year. While everyday families were struggling to justify buying a gold bracelet, the nation's central bank was buying gold by the ton. But the real twist is not just the size of that single purchase. It is what came before it. This was not a one-time decision made on a whim. This was the 19th consecutive month the central bank had increased its gold holdings. 19 months. Not once during that entire stretch did it pause. Not once did it sell. Every single month for over a year and a half, it quietly added more gold to its vault. Think about what kind of decision requires that level of consistency. A trader chasing quick profits does not behave this way. A trader buys and sells based on daily price swings, based on fear, based on excitement. But an institution that buys the same asset every single month for 19 months straight without wavering is not trading. It is executing a long-term strategy. Over that entire stretch, the central bank had accumulated 67 tons of gold. Gold now made up nearly 9% of the country's entire foreign currency reserves, a noticeably larger share than it held less than 2 years earlier. This is where the story reveals its deepest layer. A central bank does not care whether gold rises or falls next week. A central bank is not worried about missing out on a stock market rally this month. A central bank thinks in years, sometimes decades. When an institution like this commits to buying an asset month after month without interruption, it is making a statement about how it views the future of the global financial system itself. And the twist grows even larger when looking beyond just the central bank. Records show that gold flowing into the country from abroad had also surged. Import volumes rose sharply, reaching their strongest level in over a year. Buyers were bringing gold in from international markets at a pace not seen in a long time, encouraged by a price gap that made buying from abroad and selling domestically an attractive opportunity. So here is the full picture, laid bare. In the very same month, two completely different stories were unfolding inside the same country, around the very same asset. Everyday investors sold their gold ETF holdings, choosing stocks instead. Jewelers refused to restock shelves, worried about affordability. Wholesale demand collapsed to its weakest level in 16 years. And at the exact same time, the nation's central bank made its biggest monthly gold purchase in months, continuing a streak that had not broken in over a year and a half, while gold imports from abroad surged to their highest level in over a year. Retail confidence was falling, institutional confidence was rising. Both were true at the very same moment, in the very same market. This kind of split rarely happens by coincidence. When the people with the most information, the deepest resources, and the longest time horizon move in one direction, while everyday buyers move in the opposite direction, it forces a serious question. Who understands something the other does not? Is the central bank seeing risks on the horizon that ordinary investors have not yet noticed? Or are everyday buyers simply reacting emotionally to short-term stock market excitement, missing the bigger picture entirely? There is one more piece to this puzzle, one that stretches far beyond gold alone, into another precious metal facing a crisis of its own. And once that piece is added to the picture, the full weight of what is happening becomes impossible to ignore. To understand what was truly happening, one had to step back and look at the whole picture at once, not just one piece of it. On the surface, gold appeared weak. Prices had fallen from their highest point earlier in the year. Everyday investors were selling their ETF holdings. Jewelers were refusing to restock. Wholesale demand had dropped to a level not seen in 16 years. Anyone glancing only at these numbers would walk away believing gold had lost its shine. But beneath that surface, something entirely different was unfolding. The central bank was buying gold at its fastest pace in months, extending a streak that had not broken in over a year and a half. Gold imports from abroad were surging. Reserves were quietly shifting more and more toward this one ancient asset. Two pictures, same market, completely opposite stories. And here is the twist that made this divergence impossible to ignore. This same pattern, institutions moving one way while everyday behavior moved another, was not isolated to gold alone. A closely related market, silver, was quietly sending its own warning. Silver was heading toward its sixth consecutive year where demand for the metal outpaced how much of it the world could actually produce. 6 years in a row. Every year, more silver was needed than miners and recyclers could supply. And every year that gap had to be filled by pulling from stockpiles that already existed above ground, stockpiles that do not refill themselves overnight. What was driving this endless demand? Industries the modern world cannot function without. Solar panels, electric vehicles, semiconductors, advanced communication networks. Every one of these industries depended on silver in ways that could not easily be replaced with a substitute material, and every one of these industries was expanding rapidly, not slowing down. Adding another layer to this story, one of the world's major investment firms pointed out something few people were discussing. A large portion of the world's silver refining, the process of turning raw mined silver into usable industrial material, passed through facilities controlled by the very same country now aggressively buying gold. For nations building massive solar and electric vehicle industries of their own, this created a quiet but very real vulnerability, a dependence on someone else's infrastructure for a material they could not do without. So now 3 separate threads, gold's institutional buying, gold's retail retreat, and silver's growing supply crisis, all pointed toward the same underlying truth. Short-term price action and long-term positioning are not the same story. They often move in completely opposite directions, and both can be true at the exact same moment. The investor watching only the next 2 weeks saw falling prices, nervous selling, and a stock market stealing attention away from precious metals. That investor's view was not wrong. It simply reflected a short window of time. The observer watching the next 2 years saw something entirely different. A central bank refusing to stop buying for 19 consecutive months, import volumes surging, a structural silver shortage stretching into its 6th straight year, tied to industries that were not going anywhere. Neither view was false. They were simply answers to two very different questions, asked on two very different timelines, and this is the lesson that mattered most, the one worth remembering long after the specific numbers from this particular month faded into history. When everyday behavior and institutional behavior split apart this sharply, it rarely stays that way forever. Eventually, one side catches up to what the other already understood. Either everyday confidence returns as prices stabilize and stock market excitement cools, or the institutions quietly buying today turn out to have been positioning for a storm most people had not yet seen coming. History has shown time and again that when the most resourced, most patient players in any market commit to a direction for this long, without wavering, it is rarely without reason. The central bank did not need 8 months of consistent buying to prove commitment. It needed 19, and it kept going anyway. That is not noise, that is a signal. And for anyone paying close enough attention, the real question was no longer whether gold had lost its value. The real question was who had seen something worth preparing for, long before everyone else finally noticed.